radio shows.
There's a way to have your money in the market and have protected growth.
This holistic approach will help people get to and through retirement.
Absolutely.
You have to change the way that you think. It's not about having these double-digit returns anymore. Things are changing, and you have to have an advisor that's keeping up with the changes.
Your outcome is going to become very desirable if you have some sort of coach helping you along the way.
And our next recipient from the Media and Communications XP, Charisse.
Charisse Rivers.
Do not have to risk all your money in the market to survive, because it's about the retirement dream.
Hello, everyone. Thank you and welcome back to our every Thursday Facebook Live 3:30 event, where I am here to inspire, educate, and get you to retirement and beyond. My name is Charisse Rivers. I am the president, CEO, and the main financial strategist for Zinnia Wealth Management. And we appreciate you being here. We're getting lots of great feedback. Let me just give you pregame. Pregame, we're going to talk about the stock market as we are speaking at this very moment. The stock market is plummeting by hundreds. I call it by droves, and we'll explain why and tell you what's going on there. And just remember, this Facebook Live, as I know a lot of you are working and you don't have time to catch up on all the news. I'm going to try to give you as much of the news as I can at the beginning of this Facebook Live. Then I'm going to teach you a few things. We're going to talk about what the difference between exchange-traded funds, index funds, and mutual funds are here right in the middle, because you need to know why I like, and some other people out there like Susie Orman and Dave Ramsey and Howard Clark, what they think about them. And then that'll give you some good, a good thing to think about as you're deciding and sitting with financial advisors about what to invest in. And the biggest thing is we want to talk about fees and how they actually work. So that's the big thing. Then we're going to talk a little bit about 401ks. A lot of companies are not matching anymore, and what you need to do if they're not. And then we're going to go into some fun stuff, and then question and answers we'll leave for the very end. Feel free to ask throughout, and I'll stop myself in between. And I have Mike, my producer, behind the scenes that will get me some of the questions out. So, all right, thank you all so much. So, if anybody's paying attention to the stock market today, I just looked a couple minutes ago, and the Dow was down 1,800 points, which is almost 7%. And so we're hitting lows like as fast as we were back in March. So we're having a pretty big sell-off right now. And the question is just a week ago, we were going up, 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 up for about 2 weeks. We're having some nice growth. Everybody felt really good. The opening of the economy and hotels and phase 2. And then Donald Trump had his pep rally and everybody got excited. And then so what happened is we're kind of bottoming here. And if I've ever heard of something called the V shape or the W shape, the predictions were that at the beginning, there's no way we're going to have a V shape. And what a V shape means is that the market goes down into that V and it just pops right back up within a couple of months. And so we were starting to see that, but now people are saying, well, maybe we're going to see a W. And a W is really the one thing we don't want to see. And a W just means we go down, bottom out, we come back up, it teases us, we're almost back to even, but we're really not, and then it comes down again. The question is, does it go down further than the last sell-off in March? And those are the unknowns, and that crystal ball we do not have. And that's why, depending on your age and season of life, it would make a big difference on how you should be investing. So we always talk about my weekly radio show. You need to have some safe money and at-risk money. And sometimes as we get older, we want to have a little bit more safe money for living on our gobs of money that we have saved, right? So let's just be sure we're being smart. And I'm going to be talking for the masses because I know I have all different ages listening today. So I'll do my best on what you guys should be doing in times like this. And I will tell you, if you're young, don't be running scared for the hills. You have a lot of time. If markets do bottom out at 40 or 50% over the next couple of months, you have time to make this money up. Now, if you're nearing retirement and you're definitely 5 years before retirement, I hope you've already made some moves and started adding some of the safe money to your portfolio. We've done that with all of our clients. And so it doesn't mean you need to run scared for the hills either, but you definitely need to have a conversation with your financial advisors. What's the guidance? What's going on? And we'll give you some here now. And so it's a little scary out there. And so the question is investors, we tend to buy high and sell low. So where are you at? Did you buy high? Did you buy last week? And now you're at a low. Now you're thinking about selling. If that is you, then you should not be buying at all. You should not be going alone. And actually, you shouldn't be in the stock market at all during times like this, if that's what you're going to do. So if you bought last week, I hope you're holding tight, okay? Because that's the best advice I can give you for now, because this could be just a quick jump down and then we'll come back up. But I will tell you what has happened recently is that you have CNBC and CNN, they're talking about how hospitals are seeing more cases of the COVID virus. And so that's scaring people. They're wondering if we're going to have our second wave sooner with all the reopening of the economy. And so, and what has happened is a lot of people have forgotten the fundamentals because the market's been going up, up, and up, but the economy still isn't booming. I mean, you look at the TSA flight charts in March, they were at only 87,000 flying. Last week, they're at 300,000 flying and a little bit more this week. And so we got to get back to 2.5 million people flying to get back to our norm. So the fundamentals, I think, are starting to kick in. People are starting to realize, okay, we only had, I don't know, 30,000. I don't know how many people actually got their jobs back recently, but it wasn't a number that anybody was getting excited about. Restaurants are not opening. They're opening, but they're not hiring all their people back fully because they're not sure if we're going to have a second wave and have to let people go again. So, we're in a different time period and there's a lot of uncertainty. But I want you to know the NASDAQ, oh my goodness, it just rose to, I think, 10,000 for the first time ever. And so we can bank Tesla. Anybody watching the Tesla stock? It's crazy. Facebook and Amazon and Apple. So if you have any of those stocks, you're probably sitting here thinking, I am doing so good. And you are. The only time, though, and those are the ones that are really, the stay-at-home winners right now. Apple, people buying the phones and the computers so they can do Zoom. Amazon, you're buying all your food and groceries there and lots of other things. And Facebook, a lot of companies are using Facebook for marketing. So those are the companies, we call them the stay-at-home winners, which I'm a big fan of. And Tesla, Tesla is always iffy, but the owner of Tesla, he's a crazy little man. But sometimes those guys, they are forward thinkers and they really have a spotlight on the future. And so I will always bet on Elon Musk anytime. So let's talk about the fundamentals. So we've been looking at the technical indicators that are starting to line up and everything looks good, but the fundamentals of the economy. Restaurants are opening here. We have 50% capacity at restaurants. We have Disney opening up, all these other things opening up, but it's not pushing the economy. And so we're starting to look at second quarter returns, which are creating homes to be very nervous because we're starting to see the writing on the wall. And so what's happened is a lot of people had cash. And in March, when the market dumped, a lot of people said, I'm going in. So we had a lot of dough going into the stock market. And a lot of these stocks doubled from there because they had dropped so low. But now they're starting to go back again. And I think that also pushed that stock market up. Remember, the stock market is totally different than the economy. Okay, so let's look at what the chairman said. Jerome Powell, they're not going to be raising interest rates, which we all could imagine, but that news came out. And so that was very positive. But they're talking about the economy was basically going to shrink 6.5% in 2020. 2021, they're expected to show a 5% gain, followed by a 3.5% gain. So that hurts. So they've got their numbers. Anytime I hear their numbers, I always think it's probably going to be a little bit worse than that. It could be better. It just depends how many people start going out and shopping and doing some things. There's companies like Hertz and JCPenney and Pier 1 that were really, really in a lot of trouble. And I was just talking to a client that says, hey, I bought Hertz at $1.50 and now it went to $5. But those companies are the ones who are having issues and bankruptcies and they're trying to restructure their debt. Those are very scary, risky stocks. So if you're nearing retirement, I definitely don't recommend those. Anything that's going into bankruptcy. But if you're younger and you're feeling risky and you're like, hey, this could quadruple, maybe. But don't do it alone. Come see me and I'll give you the advice on there. We have Robert Kiyosaki. Anybody know who that is? Rich Dad, Poor Dad. He started a fabulous book. That's what got my business started. But he has a tweet here. Let me read it to you. It says, tweeted about booming stock markets staying. saying, if you love stocks and bonds, just jump in as prices rise. Okay, that's what we saw last week. Yet he warned about the possible return of the coronavirus infection. And he again mentions his love for gold, silver, and Bitcoin. Coincidentally, I've had 2 people in my office this past week that actually bought Bitcoin. And there is a little bit of an easier process to buy Bitcoin. I found this out recently instead of going to those coin vaults and going through that terrible long process. Just remember, if you're young, I'm okay with Bitcoin. Just remember, you can lose your shorts on it. And if you're in retirement, I'm a little bit hesitant unless you have some money to lose. You can do a little bit, but be very careful. But please talk to me before you make those moves so I can see if really that's your best idea. But, he's a big fan of gold and silver. And so a lot of people want to know, for gold and silver, Charisse, should I get it? Should I not get it? Here's my recommendation. And I do piggyback on his thoughts a little bit. There is a time to buy gold and silver, and it's when prices are low, right? And they could double here in the next 12 months if we go into a great recession, but we don't really know. So remember, we wear this tool belt and it's different tools. So be very diversified. Don't be going and putting 30% into gold. I think that would be a bad call because we don't know the future. Now, if you said, Charisse, I want to hold some gold, I want investment in gold, I want it for bartering, if all falls through the roof, well, then guess what? I would say 5 to 10% of your total portfolio would be my max, in my opinion. And that is still a lot. But make sure you go down to the local shop, your pawn shop, wherever you go to buy your gold locally. And just make sure, ask them when you sell the gold back, what is their commission back? If it's 9 and 10 and 12%, don't buy it. Give me a call. I'll tell you who are the local stores that are really good at keeping commissions down when you sell your gold back, because you have to make so much money to even sell your gold. And remember, most people are not great at buying and selling at the right time, so you really hold it for a lifetime. So gold, what I find out is people just end up leaving it for a legacy, and many of them don't cash it in. And when they do, it always seems to be at the very, very wrong time. So any tips there is good. Now, Kramer this week, he has said a lot. His tune has changed from last week, but he did forewarn viewers. He said, investors this week avoid risky stocks like cruise lines and airlines. They're saying avoid cruise line and airlines. This is what he's saying. He said those are very, very risky right now. He also warned against buying stock companies that have filed bankruptcy, just like I just said. And that could be a major, major losing game, as he says. He says maybe buy fractional shares instead of buying full shares, so you stay a little bit diversified, which I agree with. But not all companies allow you to do that. And I think Robinhood is one company. I'm a big fan of Robinhood if you're just getting started, and even if you're not, you can do some things there that you can't do at these really, really big banks and brokerage firms. So I'm a fan of that, and I could walk you through that. Okay, let's move forward. So next in line. Before I move forward away from the stock market, just be careful. If you have cash on the sidelines, you might be wondering, should I run towards the market or should I hold off a little longer? And so I think it depends on your age. If you have cash that you're willing to lose and you can hold it long term for, just in case if things get bad in our economy, then it's okay. As long as you have cash elsewhere to live on. Just any money that you are living on. I had somebody come to my office today and said, Charisse, I have this $60,000 we're going to be living off the next 6 months. Should I invest half of that in the market? I said, absolutely no. Your short-term dollars should not be anywhere but the bank or something, money market, making maybe 1%. You don't want any fluctuation on the dollars that you need today. And if you're still taking money out of the market and living on that money right now, you have to stop. It is going to erode your portfolios and you're never going to get back to even. And it's a negative. So if you lose 10% and you're pulling 4, you just lost 14%. It's going to take so much more energy to get back to even. Remember, we take those stairs down, the elevator down, and we take those stairs up. And so if you look at 2008, the market dropped 50% from 2007 and 2009 over 17 months, but it took people to 2014 just to get back to even. And that's as long as you weren't living off that money and you were actually contributing to your retirement account. So just be careful if you're nearing retirement. And for you young folks out there, you could invest, but don't invest in companies that are going bankrupt. I'm okay with some of the better cruise lines and the better airlines. And but let's just see what happens here next week. Let's hope Donald Trump comes out and does his typical pep rally on Friday and it moves the market over the weekend and we're looking good next week, but we will see. It could be one more bad week before it goes back up, and it could be 6 more bad weeks before it goes back up. So again, I'm not going to pretend to have a crystal ball, but we are watching it very thoroughly. All right, Trump news. So what is Trump doing? Well, he has dropped in popularity on polling, basically due to this protesting. He's taken some heat this week, suggesting that a 75-year-old man who was injured after being shoved by police officers in Buffalo, you have been part of a setup, and he's saying maybe it's part of Antifa. I don't know if you guys know what Antifa is. You can Google it. It's kind of crazy stuff, but they think that there might be other communities trying to do bad things to make Trump look bad, or, just have, hecticness in our world. So yeah, his popularity has dropped a little bit, but I don't know how long that'll last. We will see. Other news, economy reopening. Trump is set to hold his first person fundraiser. So he's going to do a fundraiser here. And his goal is to raise $10 million. 10 million, that's it? That's all you got, Trump? Come on now. 10 million? I think Michael Jordan just raised more than that on his fishing tournament. So we'll see what he ends up doing there. Now, let's look. What is Governor DeSantis doing this week? He's always doing great things. I really like our governor here in Florida. But basically, he announced late last week that 64 Florida counties, all except Miami-Dade and Broward and Palm Beach, have entered phase 2 and for the recovery plan, which is good. And bars and movie theaters, entertainment venues are allowed to open, and social gatherings, they have up to 50 people. So I am a little nervous about that, only because 50 people, we are worried about this second run through of the flu, but that might be, I think 50 people is excessive, but we'll see how that works out. Just kind of, that's not good news in my opinion. I've got to put that out there. Here's the other thing is Governor DeSantis is polling to get the GOP convention in Florida. So they're talking about places in Jacksonville. So we want that stuff to happen here, because we want money coming into Florida. We want, to keep our hospitality industry going. Florida is a hospitality booming state, and we got to keep those households going too. Central Florida, here's some cool stuff. NASCAR will allow fans to attend upcoming races in June under social distancing guidelines. It's called the Dixie Vodka 400, which takes place in Florida June 14th. You have to wear face masks, and you got to be 6 feet apart. Okay, so this is all I have to say about this. It's called the Dixie Vodka 400. All I heard was vodka. Can you imagine the people that are setting up shop there? It's got to be every vodka company under the sun. And they're probably giving some free testings out. And so what happens? People start drinking, and all of a sudden they're hugging, and they're all buddy. This could be a disaster. So I'll be curious to see what the news cameras pick up from that event. Hopefully people will be responsible, though, even if they're drinking. But interesting, you can go check out some NASCAR. Disney resorts are reopening June 22nd. Okay, so we have some hotels opening up. So it looks like, they can fill it up about 50% of the way, maybe more. Time for Disney. I'm going to say, if you go to Disney, Disney and Universal Studios, all those places are ready to go. This could be a good time to visit, because there won't be as many people there as usual. So, something to think about. And Gator news. So I can't leave my Florida Gators out. I'm an alumni. Go Gators. Anybody else out there? Go Gators. Go Gators in the chat box. I like to know who my Gator fans are. And if you're a Seminole, go ahead. I'll heckle on you a little bit. But it looks like the Florida team has returned to UF campus. Most of the players are back, and they have tested and screened for the coronavirus. They're all back lifting weights and back to a regular schedule for fall season to start in September. So there you go. Looks like everything is moving forward. I'm just curious how they're going to treat the fans in the stadiums. But, worst case scenario, they have a football game. Only half the stands can be filled up. And if that's our worst case, it's better than nothing. At least we get some real good football. All right. And that ends our first segment, markets and what's happening in Central Florida news. All right. So this is where we go into this section where I'm going to teach you about some stuff. This is what you need to break out your number 2 pencil or pen and start taking some notes, because this section we're going to be talking about now, is that we're going to talk about mutual funds, exchange traded funds, and index funds. And the number one fund out there that most people have in their portfolios when they come into my office and we run these reports for them are mutual funds. So go ahead and write them down on a piece of paper. Write down mutual funds, index funds, and exchange traded funds. I'm going to go slow here because I want you to take some notes, okay? So what is a mutual fund and why do most portfolios, I want you to look at your portfolios after this and see which one you have most of, and I guarantee most of you have the mutual funds. Think of a mutual fund as a safer way to invest, but it's not really a safer way. It's just a way to be diversified. So for example, let's just say you get I'll pick American funds because they're a popular name out there. American funds, large cap fund. So large cap means big companies. So you have Coca-Cola, you have Netflix, you have Amazon, you have Disney, you have the big companies, and they're usually all domestic companies for the most part. And so think of it as this barrel. You have this barrel and you have this American fund who is the manager, and they get paid to manage your fund and buy and sell within the fund, right? And what happens is they charge you typically an average of 1% fee. That's the internal fee. That's your American fund. That's a 1% fee. Put that down. And then they have these little minions. We call them financial advisors. And they also get a commission or a fee as well. So for the most part, on average, over a 7-year period, you're probably looking between commissions and fees all in between 1.5 to 2% a year. But most people don't know that, and you don't see it because it comes off the top. But you need to know that. Mutual funds are widely sold by big banks and brokerage firms, which is okay. And how the advisor makes money on them is by charging you a commission. They call them a load, and they can be in the front or in the rears or somewhere throughout, but most of them take it in the front. So they'll have your mutual fund company's name, and it'll say A. That means all your commission came out in the front, and that can be between 3 and 7% off the top. So if you start with $100,000, basically you're losing 7% right away. Let's just hope the market's going up during that time. So a mutual fund, you have all of these stocks in there. So you don't have to go out and buy Amazon because Amazon's really expensive. If you try to go buy Tesla, that's $1,000 a share. But the mutual fund might have a little Tesla, a little bit of Amazon, a little bit of United Healthcare, and it keeps you diversified, especially if one of those companies go belly up. Maybe it won't hurt so bad. It won't be a complete doozy, right? And so that's the mutual fund, and that's what we're used to seeing. Those are the things that we see on TV all the time. And so somebody's got to pay for those commercials, and that's you basically. So a mutual fund. And so you get management from the manager. So if you don't want to go buy stocks and figure out when to buy and sell them, maybe you get a mutual fund, right? And they'll do it for you. One thing about mutual funds that I don't like is that when they do make a sell, so let's just say you have 100 stocks in this one mutual fund, and all of a sudden the manager at American Fund says, I don't like Coca-Cola anymore, so I'm going to pull it out and I'm going to put Pepsi in. Right? We don't really know that till like a couple months later. So there's not a lot of transparency there. And so that is a mutual fund in a nutshell. I'm going to have you take some notes here in a minute, but I'm going to go through this explanation first. So mutual funds are okay. This is what we're used to. Dave Ramsey's a big fan of them, but I need to tell you why I'm not the biggest fan of them. So the next one is called the exchange traded fund. So the exchange traded fund is the same thing. It's a barrel, but I wish I was in my class, teaching my class. I have this barrel, and they're doing the same things. They're putting some Coca-Cola, they're putting Disney in there, they're putting maybe GE, hopefully not, that was a joke, AT&T, they're putting these big companies in here, and it could be the iShares S&P fund. And the iShares S&P fund might have 100 companies in there. And so their job is also to buy and sell these funds at different times. And so it's really the same thing. And the difference between the exchange traded fund and the mutual fund is this. The costs are much lower. So typically there's no commissions to the advisors on exchange traded funds. And the internal cost is literally 0.5% or lower, but we see them at like 0.02, 0.03. So you're really saving on fees. So you have to ask, okay, I've looked at my portfolio and I have 100% mutual funds. Why don't I have exchange traded funds in my portfolio if I can save money on those? And if they're just as good as the mutual fund, right? And so what it has to do is it has to do with the cheddar. It's the money. Big banks and brokerage firms can't make any money off exchange traded funds because you can't earn those commissions and you can't charge those higher fees. So the people that you're working with, a lot of people are working with the big banks and the big brokerage firms, and that's okay, but they can't make any money off that. So let's just say, for example, you go to Wells Fargo, and Wells Fargo gets this new IPO, a bond IPO, and you already have a bond at Wells Fargo, and it's doing really good, but now Wells Fargo has to push this bond out because, you know, we got to look good. We have the IPO. Let's sell, sell, sell. So they tell all their advisors, hey, we have this new bond. Maybe go ahead and sell your old bonds with your clients and put this new bond in. And the question you have to start asking yourself, was that the right thing to do? Or was this just another way for Wells Fargo and their advisors to make money? And so there's a little conflict there that I think people, have been duped on over the years. And there has been some changes with that. And so just be careful what you're getting. And if you do stick with your bankerage, that should be a new word, your brokers and banks, you can wheel and deal a little bit, talk to your advisor, be like, everything here, you're charging me a fee and I get you want to, make some money, but can you give me some no loads? Can I get a little discount here since I've been committed to you for so long? So no load mutual funds, that's much better. You're going to save so much more money. And that's kind of how you can wheel and deal with your financial advisors. Now, if you look at your statements and you have a portfolio full of exchange traded funds, well, you already know the advisor is not making a commission, and you already know the internal fees are really low. And so usually the overall fee annually is somewhere around 1 to 1.5 out the door, which is typically much lower than the mutual fund. So you get to save there. And so food for thought. Now, the third one on the chopping block is the index fund. So everybody knows what the index fund, it's the S&P 500 index. Right? And people say, I want to get the index fund, Charisse, because it is literally like 0.1, 0.2 in fees. And basically it's more passive because it's just the index. This fund is supposed to follow the index basically. And so I wanted to start with these basics because you could be really young. And I honestly recommend for the young people between 25 and 45, you don't have to go alone on this, but based on what I'm telling you, you don't need to go to a financial advisor to charge you commissions and fees. When young people come to me, I don't charge them any kind of fee. I can't even charge a commission because I'm a fiduciary when it comes to stock market stuff. But I tell them, I'm like, instead of me charging you an annual fee, why don't you come see me once a year, pay me a couple $100, and I'll give you your plan, and maybe we do it every 2 years. So when you're young, maybe you should be in the index funds because it's passive. Your job is just to grow. Jack Bogle of Vanguard says, does that one open those statements? And to me, that is pretty much a true statement. The younger we are, because when we're young and you start seeing fluctuation, you don't want to sell because sometimes when you sell too soon, you also miss the up. And so then you have regret. So be very careful there. But if we're a little bit older, we're 55, we're 50 years old, that's when you really want to start working with a financial advisor, probably a fee-based advisor, because the fee-based advisor basically isn't charging you commissions to buy and sell and do all this. They just get their fee every year, and they're supposed to do their job, and they're supposed to plan for you. And so that's a big difference between age brackets. And for the young people, I'm a big fan of Vanguard because there's hardly any fees in Vanguard. I'd love to talk to you about it, but I do send a lot of people over there because of their lower costs, and their funds have done very well. Excuse me. I need some water. So now you have the basics. So now what I want you to do is I want you to, on a piece of paper, write down mutual fund, and underneath it put 1, 2, 3, 4. And right next to that piece of paper on the other side, kind of like a little T-chart, put ETF, and underneath it put 1, 2, 3, 4. Because I want you to write down these very specific notes. If you get anything from me ever, this is very important. Mike, are you taking notes over there? My producer, Mike, behind the scene, I see him writing stuff. That's great. Thank you. Makes me feel good. Okay, so number one, we're just going to be comparing mutual funds to exchange traded funds at this point. So number one, next to mutual funds, put commissions and loads. I just went over this with you. So there's commissions and loads, and they can range between 3 and 7%. I've actually seen a couple at 1%, which is shocker. There's very few far in between. So that's how the advisor makes money. And that's okay because, the advisor has to make money somehow, but that's just something for you to know. Now, underneath the exchange traded fund, write down number 1 and then put no commissions and loads. So we're just doing an apples to apples comparison. So the mutual funds has commissions and loads, unless you get that no load one, which doesn't happen typically. And then you have the exchange traded funds that have no commissions or loads. I will say I'm always looking at the prospectuses of these exchange traded funds. And recently I saw one that had a 2% load. So I called the company and I said, what is this? You guys aren't supposed to have commissions and loads. And they said, actually, it's waived. We put it in there and they gave me some excuse from the balance sheet. But what I found out with the math, that they really weren't taking it out. So that was really interesting to me. So you need to know what the fees are there. So now let's go to number 2 under mutual funds. Write down expense ratio. So the expense ratios can range between 0.5% to 1.5% on a mutual fund, depending on which mutual fund you have, and if it's domestic or global or international. And so those internal fees, they just come off the top. You don't see them, but you always get sent this prospectus. It actually says it in there, okay? And this is how the manager, this is how they pay for the paperwork coming out to you. This is how they pay for the building and the light bills and all that kind of stuff, right? So that goes to that kind of stuff, because that does not go to the financial advisor. The advisor makes money based on those loads and commissions. Now, go over to exchange traded funds and under number 2, put expense ratio. Typically, for about 85% of them out there, they're about 0.5% or lower. Okay, but I really see, like, the ones we're using 0.2, 0.3, 0.4. We might have had one at like 0.6 at one time, but it wasn't producing the returns. And I think that's why we got rid of it. So you got to be careful with fees, because if you're going to charge you a fee in exchange traded fund, you want to make some money. So fees are really important so far, right? Because if the market goes down 10%, your mutual fund lost 10, your exchange traded fund lost 10, but this one has a 1% fee and this one has a 0.2% fee, but they're doing the same exact thing. Which one do you think is going to get back to even first? Which one do you think might possibly put more dough in your pocket? Well, you guys can figure that part out. So number 3 under mutual funds, write down trading efficiency. And I will get to any questions that are out there in a minute, unless I'm answering most of them, but let me get through this. Number 3, write down trading efficiency. So if you call your financial advisor at 10 o'clock in the morning and you said, stop the bleeding, I've lost 20% and you're not doing anything to stop the bleeding. They sell it at 10 o'clock in the morning. You don't know what price you get to the end of trade day. So if you did that this morning, the Dow Jones has gone down 1,800 points. You just lost 7%, even though you wanted to sell out earlier in the morning when the market was only down 850 points. So you lost double, basically. So mutual funds, you just don't have the quickness. The advisor doesn't have the control to get out instantly. It doesn't act like a stock. So trading efficiency is a big deal. Okay, the stock market dropped 1,861 points. That's 6.9% for the day. I just got a pop-up alert just to let you guys know. Bad day. I hope nobody sold early this morning. Okay, so back to trading efficiency. Go over to exchange traded funds number 3. Put trading efficiency. If you call your stock jock and say, hey, at 10 o'clock, sell me because I've lost 20%. You get that price sometime that morning, and it's usually pretty quickly, instantly. And 10, 10:01, 10:02, maybe 10:05. But at least you don't have to wait for the rest of the United States to make that sell and lose even more. So I love exchange traded funds because of the control you have. You can sell instantly, and that is very important when you're working a financial advisor, and that is called efficiency. Okay, if you want to make moves, you got to make moves. You don't want to wait for the rest of the United States to see what number you get, because that is detrimental. So that was number 3. Now go back to mutual funds. Here's the last one, number 4. Write down tax efficiency. So tax efficiency is huge. So remember we talked about this big barrel, and you have American funds, and there's a lot of other companies. I'm just using their name, and they have Coca-Cola, and they have Netflix, and they have AT&T, maybe Kraft macaroni and cheese, whatever it is, Hoover vacuum, but maybe 100 companies in there. And let's just say American Fund one day says, we're going to get rid of Coca-Cola and we're going to replace it with Pepsi, because Pepsi is a forward-looking company and we see some really big things on the horizon from them. When they sell that, if this is non-IRA money, you get a lovely love letter from the IRS. It's called your 1099, saying you owe capital gains taxes on the sale. And you read this, you're like, I didn't even know I owned Coke, but because you had that mutual fund, you did. So you have to pay taxes on that deal, and that's not what we want to do when we're buying and selling funds like that. So you got to be careful with mutual funds and the tax efficiency part of it. Now, if it's an IRA, it's okay, you won't be taxed. Now, go to exchange traded funds, number 4. Write down tax efficiency. So the very last one. If remember they have a barrel and they have, let's say it's iShares S&P 500 fund. I'm just doing apples and apples comparison, and let's say they had Coca-Cola in there, like we want to get rid of it and put Pepsi in instead. Guess what? You don't get a 1099 and you don't pay the taxes. So they're very tax efficient if you are looking for something like that, and you're just not looking for a bunch of trades all the time and then having to deal with the taxes. Because if we can wait for taxes later, well, that's an ongoing conversation that we're going to have taxes, but it's just more efficient there. So now you guys can see if you did write down, or you can go back and watch this later, okay, you're going to go back. Now you look at your portfolio. You're like, okay, mutual funds, are mutual funds better or exchange traded funds better? And that's really up to you to decide. I gave you the information, and most of my portfolios are full of exchange traded funds and index funds, just because the efficiency and the costs and so on and so forth. And so if you're out there asking a question, I saw one question come in, what if I do half mutual funds, half exchange traded funds? You can do that. You know the rules. So there's no harm, foul. You've been informed. And the other question that I saw was, well, does a mutual fund make more money than an exchange traded fund? And here's the thing about that. Do me a favor, Google the Dalbar study. The Dalbar study, D-A-L-B-A-R, it's basically guidance on these mutual funds and exchange traded funds over the last 25 years, and it rates them. It tells you how well they are doing. 2 years ago, the Dalbar study said mutual funds failed 80% of the time. So you pay this money manager to be really smart and buy these funds, but they're failing 80% of the time. So that means only 20% of the mutual fund companies out there were doing really good. That's scary because you're paying those commissions and loads and internal costs. If that's the case, why wouldn't you just go to an index fund or an exchange traded fund that might be having the same bad luck, but at least your fees are a lot lower? So when people come in, anybody who comes in and sees me, you get a portfolio x-ray. In that portfolio x-ray, we have to have your statements. We're going to see every fund that you own. We're going to look at the risk on it. We're going to look at the fees, those expense ratios that you need to know. We're going to look at the commissions. We're going to look at the returns, and we're going to see how well it's really done over the 1, 3, 5, and 10-year period, because it's good to know, because I might say, okay, you have 20 funds here. 10 of these are just terrible. Let's get rid of them, and why don't we consider buying this? So after you leave our office, you get this wonderful report, and it really tells you where you're at. And I could be sitting with a 50-year-old that's not retiring for 15 years, and his portfolio tells us that during the next crash, he'll lose 40%, but he's got 15 years to retire. That is actually okay, because we have time if there are losses, but we still want to mitigate losses, and there's other practices and ways that you can do that. But a lot of times I'm sitting at the conference table, I'm sitting with a 55 or 60-year-old, and across the conference table, they look like a 35-year-old. And I said, did you know you could lose 38% if the market crashed? And they went, no, I didn't. I thought it was diversified. Being diversified is not a plan, people. You have to have a plan. Being diversified is very important, but what does that really mean, right? And so, I'm sharing this and expressing this information because it just happens every day in and out in my office. And you need to know now, better to know now and get a second opinion now than waiting 2 years, 3 years, or even 6 months. So take action now. Our reports, by the way, are zero cost. You can go to zinniawealth.com, upload our guides on volatility, and those concerns are there in the education center. And if you want to see us or you have questions, you can type it in right there. And so I definitely advise on that. And there's a little red book to retirement that I recommend. I don't care what age you are, you all need to be reading. It's only 37 pages, called The Little Red Book to Retirement, and it's free. And I encourage it. So start getting you thinking about these things. Do I need a will? Do I need a trust? What kind of funds do I need? Social security planning, there's so much. So I encourage that. So I really talked a lot about these mutual funds, exchange traded funds, and index funds. Just so you know, we also teach this kind of stuff. I go into a little bit more depth in my classes that we're now starting to hold, we have one in Beverly Hills next week. In Ocala, we're going to do one at the Hilton after 4th of July, the week after. So just check on our events page. We'll let you know when those are. But it's 2 hours of information that I've kind of locked barreled down so we can feed you guys as much as we can. So, and any questions there, Mike? I think I answered a couple of them already. So the question is it true that mutual fund managers don't typically beat the indexes? So if you go Google Dalbar study, D-A-L-B-A-R, Dalbar study, you can find that information there. And yes, and so the job of this mutual fund company and exchange traded fund company, the goal is you're paying them a commission, you're paying them these internal expenses. Their goal is to beat the benchmark. So great question. So the benchmark, so if you have an American fund, large cap, large companies, domestic, and if you also have an iShares S&P fund, their job is to beat the S&P 500. That's your benchmark you're comparing it to, only for those types of funds though. And what happens is, 70 to 80% of the time, the mutual fund managers fail to beat the benchmark. Isn't that incredible? So you're thinking now, well, if that's the case, why don't I just go invest in the benchmark? Ding, ding, ding. And so we're a big fan in our office investing in the things that we're already trying to beat. So the index funds. So we like index funds coupled with exchange traded funds. And yes, and it doesn't mean that the exchange traded funds are beating the market, but we just know the fees are lower and you're being diversified with some of those choices. So yes, that is a true statement. And then the other thing that you'll find is that it says, when the 20 or 30% that do beat the benchmark, the next year they usually don't. So for a great example, last year we had a lot of iShares in our portfolio, but this year you're going to notice we really don't, because they did a really good job last year. And this year they're not doing as great of a job, in our opinion. And so we have less thanks to our money movers. And now what we're starting to find out is, anybody caught whiff on what's happening with iShares and the losses and some issues for investing globally they have? So I'm thinking, what do you know? So it's really up to your financial advisor to decide, do we stay in, do we get out? That's what you pay your financial advisor for, okay? They shouldn't be asking you. They should be doing it, of course, and then conveying the message and making sure you're okay with it. But yes, another question there, Mike? So can you get index funds with other asset classes like small cap, real estate, international, and bonds? Absolutely. In every asset class, you can get an index fund, you can get an exchange traded fund. Like I said, if I have to have it, I have diversified portfolios for my clients. I have index funds that cover every sector. I have exchange traded funds that cover every sector, from health to real estate to gold and small cap companies, because there's a time to be more heavily weighted in small cap companies, but then it's your advisor's job to say, okay, we're going to pull back the reins because small cap companies aren't doing so good. It might be 12 months that they're not. So maybe we go more into large cap because the large cap might be doing better, right? Those stay-at-home type funds, those large cap stuff. So it's really up to your advisor to decide when you're going in and out. And if you have algorithms and formulas in your portfolio, which I do, and I also have some customized portfolio that helps with trying to become a little bit more conservative in a portfolio. We also have some exit strategies in our portfolio. So here's 3 questions you should be asking all your advisors. I used to have 10. I now have 3. The first question is, are you a fiduciary? Okay, fiduciary financial advisor basically is, they're just overlooked at, differently. We have stricter rules. And they've really got to make sure they're dotting their I's and crossing their T's and making those decisions right for you the first round. And I know people aren't perfect, and life happens, and there's some bad apples out there. I've heard recently of somebody else from a client of mine. But for the most part, you'll find a lot of fiduciaries that, are trying to do their best and find the best thing for you, which is really, really important. So fiduciary, because there's 2 different financial advisors. There's a fiduciary financial advisor, and then there's the non-fiduciary financial advisor, and their job is typically just to make sure the stuff they're putting you are in is suitable. So it's quite different. The fiduciary is supposed to look out for your best interest before their own pocketbook and anything else. And so that's kind of the thing behind it. So to me, you should always have a financial advisor that is a fiduciary. And so the second question is when you're talking to your advisors or interviewing advisors, ask them, okay, so you are a fiduciary. Okay, do you have an ADV form? This ADV form, it's Apple David Victor, ADV, advisor form. It will have their name on it. If their company's name is on it and their name is not on it, they're not a fiduciary. So their name has to be on this ADV form. And that ADV form basically says, what have they been up to? Have they had any lawsuits? Have they had any issues? And if you go to zinniawealth.com, on the front page, there is a FINRA check box somewhere. Just scroll down a little bit. You just click it. You can type in your financial advisor's name. You can learn all about them. And when you find their name, let's say you type in John Smith, not picking on anybody, it's just a popular name, and their name doesn't come up, well, they're not a financial advisor. So you're probably wondering, should I be working with a financial advisor? Who am I working with? Now, if John Smith's name pops up and it's in red, well, they probably hightailed it to Mexico and you probably lost all your money, and you're going to be going through lawsuits at this point. That happened in Ocala locally last year. I had no clue, and I pulled up a name. I went, oh, and people can't get their money. And then if their name does pop up, okay, that's positive. We like that. Means they are some sort of financial advisor. They're following the stock market. There's two blue bubbles. The first blue bubble says B, and the second blue bubble says IA. So if it pops up and the name pops up and it only says B, that means they're actually not a fiduciary. So so if you don't feel comfortable asking your financial advisor, you can just go to the site and find that information there. It says B, they're not a fiduciary. Now, if it pops up and only IA in the blue bubble, I for investment advisor pops up, that means they are the fiduciary. So there you go. But here's the other deal. What if both bubbles pop up? The B in blue and the IA in blue. It means they're a broker-dealer and they're a fiduciary. So here's my concern with that means they have to serve two masters. They're serving their brokerage firm and they're serving you. To me, that's a little bit of a conflict of interest, in my opinion. You guys can make your own opinions. I truly believe the fiduciary out there is one that says IA on it, because if it does, it means they can't earn any commissions on sales. Okay, if it says B and IA, that means they can charge you a fee now and get commissions. So just remember that. And so that was the second question. Prove that you're an investment advisor, fiduciary. The third question I always ask, if you're 50 and above, third one, it's the most important one. It's the one we always forget. What is my exit strategy? Yeah, that's a big one. That's the biggest one. That's more important to me than fees at this point, because you guys kind of already are figuring out what fees are. What is my exit strategy? And if you're in or nearing retirement, you probably want an exit strategy on some sort of your part of your money. I mean, if the market crashed and you lost 40%, that's not a good thing. So what is your exit strategy? Most of my clients have an exit strategy on their portfolios, and so far haven't had too many complaints on that. So that's a great thing. And we're moving back in the markets, and we will play conservative for a while, and then we jump back in when all the stars align. So that's a good thing. So those are the three questions you should be asking your advisors. And again, I don't have 10 anymore. I only have 3. Any questions on that, Mike? Good. I answered them. Perfect. All right. Lots to talk about there. I'm going to move on. Mike, how long have we been going here real quick? Okay. So I don't want to draw this out too long. I was going to talk about 401ks. I'm going to skip it and move it to next week. So I really try to keep this to 55 minutes max. So I've been talking a lot. So let's just move on and talk about good news and some stories. The first story, I want you to watch this video. It's only 40 seconds. So I have to tell you, it's a Florida Keys. I'm from the Keys. I'm from Tavenera. I went to Plantation Key Middle School, Key Largo Elementary, Coral Shores High School. So I'm from the Keys. I never in history have ever seen this, but so cool. So basically, they had a graduation ceremony and they did it on jet skis. So Mike, do you have the video about ready to roll? All right, put it up. Oh.
Unique times call for unique measures. We've been telling our class of 2020 that any challenge can be overcome. So this is another challenge that we're going to overcome, and it's going to be their last challenge that they have to overcome for high school as they go out and start their life.
Okay, was that cool? That is cool. Just so you know, most kids in the Keys, they learn how to ride a wave runner early on in life. Some of you are probably thinking like, I wouldn't even know how to do that. But in the Keys, they're just there. So great way, how fun, because I know there's so many high schoolers out there that just didn't have a graduation. They didn't get to go to Disney World and do the one night at Disney. I can't even imagine being a senior right now because I had such a fun time graduating and having a real graduation. So I do feel for those kids. They'll probably be scarred for life, by the way. So next, lastly, Ocala news. We have the Ocala Breeders sale holding their sales for 2-year-olds right now. And so sales have been a little slow. They had to cancel one sale not too long ago. And so there's not as many people here as they would have expected, but still a good amount. But what they did is they got creative, and they're doing online bidding. How smart was that? So that's helped sales here locally. OBS is right down on Airport Road. Anybody can go down there and check out the horses, even if you're not even looking to buy. Go down there and support our horse industry because they'd probably really appreciate it. And it's something to do. So I know it's going all weekend, pretty sure still. And I took my kids out there one time. Just be careful because sometimes horses like to bite. You got to be careful when you're walking around. So anyways, that's local news. And don't forget, we have last week we were rained out. We have that farmers market very close to OBS and we're doing all those sales. So if you're looking for food, there's 40 vendors down there. That might be fun for you to do also. Okay, I think we're done with questions. And if you have any last minute questions, go ahead and put them in. If not, we'll save them for later. And I know I answered a lot of them. So again, Mike, let me know. But I really appreciate everybody tuning in and listening. I gave you a lot of information on mutual funds, exchange traded funds, and index funds. And these products are ever evolving and changing. And you might be wondering right now with the stock market where it is, it's down almost 1900. Do we invest now? Let me do a phone call with you and see where you're sitting and see where you're at and what season of life you're in before you just jump in full throttle. And remember, if you are nearing retirement, we want some at-risk money and safe money. And I'm not talking about bonds for your safe money, okay? Remember, we wear this retirement tool belt, and my goal is to inspire you, educate you, get you to retirement and beyond, and doing it the proper way with proper planning. Okay, don't forget you get a portfolio x-ray from us absolutely for free if you send in your statements. We'd be happy to give you some good feedback and send that out to you. We're doing appointments in office and we're still doing Zoom and conference calls depending on what you like. Go to zinniawealth.com, download your little red book to retirement. It's 37 pages. It's absolutely free. And if you want to go to our education learning center, there's a ton of guides you can download from, you name it, taxes to Social Security to volatility stuff. It's there, the Secure Act, and read up on it if you're trying to catch up on things. So I appreciate you all. Thank you for tuning in to our weekly 3:30 live segment here on Facebook. Live by design and not by default. And we'll see you here next week.
She is a financial planner and advisor.
She's the founder and president of Zinnia Wealth Management. She's also a popular radio show host.
There's a way to have your money in the market and have protected growth.
This holistic approach will help people get to and through retirement.
Absolutely.
You have to change the way that you think. It's not about having these double-digit returns anymore. Things are changing, and you have to have an advisor that's keeping up with the changes.
Your outcome is going to become very desirable if you have some sort of coach helping you along the way.
And our next recipient from the Media and Communications XP, Charisse.
Charisse Rivers.
Do not have to risk all your money in the market to survive because it's about the retirement dream.